definitely feeling the summer vibes. I mean, I know I'm wearing all black, but the vibes are in here. Hi, my name's Vashi and I like to talk about finances, well-being and being single. This video is going to be about how you might want to carry out research when you're looking for stocks to pick to invest in. And don't worry, as always, everything is beginner friendly, no scary language, because I believe everyone can and should invest.
I'm not a financial advisor, so please do your due diligence before you start investing.
I'm just here to spark your interest in investing and hopefully get you started on your investment journey, because I genuinely believe this is how you become wealthy. Not rich, wealthy. Okay, let's get into it. In fancy investor talk, doing your research before choosing what to invest in is called fundamental analysis. And this basically means you're looking at a number of different factors, such as a company's financials to the broader market environment, just to decide on whether you think this company is worth investing in. Okay, so let's look at the financial side of things. When it comes to the financials, there are 5 key terms you want to familiarize yourself with. The first one is revenue. Revenue is basically the amount of money a company has brought in a specific time period. The second term is net income. Net income is revenue minus costs such as operating costs, taxes, and any other costs required to run the business. So think of it kind of like your take-home salary after tax. That's net income. The third term is earnings per share, or EPS for short. EPS is when you divide the money the company makes by the number of shares it has available to trade. This number gives you an idea of the profitability of a company and makes it easier to compare to other firms, and is usually used to determine the financial strength of a particular company. And so obviously, the higher this number, the better. However, EPS shouldn't be used on its own as an indicator for a company to invest in, because it doesn't really tell you how the company is using money. For example, some companies will take their earnings and reinvest it back into the business, whereas some companies will take their earnings and distribute it among their shareholders. The fourth term you need to be aware of is the price to earnings ratio, or PE ratio for short. PE ratio is when you divide the company's current stock price by its EPS, so its earnings per share. A PE ratio gives you an indication of how cheap or how expensive a particular stock is relative to its earnings. When you're buying stocks, you ideally want a low PE ratio, which basically means the stock is trading lower relative to where the company's earnings are. And that's what you want as an investor. We love a bargain out here. Okay, and the fifth term you want to be aware of is return on capital, the ROC. A return on capital is the best metric to determine profitability in a company. ROC can be calculated by dividing net income by the cost of invested capital, and this is expressed as a percentage. This figure will give you an idea of how good that company is at generating profits with a fixed amount of resources. Profits are great, right? But what's more important is how much it costs to generate that profit. Companies with a high return on capital are basically making a lot more profit with fewer resources. Any ROC that is in double digits is considered to be good. All of the metrics that we've just covered you can find on a company's financial statement, and you can access this via a stockbroker's website or your stockbroker's app or a quick Google. This information is readily available online, and I suggest you try calculating some of this for some of your favorite companies just to see how well they're doing. Okay, so we've looked at the company's finances. The next thing you're going to want to look at is the company's debt. Most companies have debt in order to grow, so it's not necessarily a bad thing. As long as a company has enough cash to meet its debt commitments at the end of each month, having debt is just part of the day-to-day of running and growing a successful business. However, what you want to spot is companies that have tons and tons of debt on their balance sheet that it's unlikely to be able to pay back for a very, very long time. To assess the company's debt, you want to divide long-term debt by free cash flow. And these figures are easily available online again. The resulting figure you'll get will give you an indication of how long it will take this company to pay off their long-term debt commitments. And obviously you want this to be a low figure, so anything, as a rule of thumb, below 3 years is good. Okay, so we've covered some of the basics of the company's financials, which is called quantitative analysis, but there are also some other things to consider when you're choosing stocks to invest in. For example, competitive advantages the company has. And this type of thing is called qualitative analysis. Things you might want to consider are, does this company have a competitive advantage? Is they have, or what they do, difficult to imitate? Do they have research capability? Do they have a strong brand, or are they leaders in innovation? Do they have any patents? All these things add to the company's competitive advantages, also called a moat, and the stronger this is, the better. You might also want to think about how the company makes its money, and also whether or not you understand what it is they do, and whether it aligns to what you stand for as a person. For example, you like fashion and you understand how the clothing industry works. But is fast fashion something you want to invest in and something that you stand for? If you're concerned with short-term profits, then perhaps. But if you're concerned about long-term investing and sustainability, this might not be the best option. You might also want to look at the leaders of the company, its culture, and just broader what-if questions. For example, are there any emerging trends in the market that might affect this company? For instance, if this was 20 years ago, you may have considered investing in Blockbuster, the video service, for those of you who know. But you may have spotted the emergence of Netflix, and that may have swayed your decision in what to invest in. But this isn't the easiest thing to do, and no one can predict the future. No one predicted the last 2 years we had, right? And even the owners of Blockbuster didn't see Netflix as a threat. So I don't know what to tell you. Pairing this qualitative research with the quantitative research should help you make a more informed decision when you're picking stocks, rather than just following the hype and following things blindly that you see on social media. Putting these things into practice before you invest in stocks will set you up really nicely for the long term and make you a better investor. Okay, that's it for today, guys. I hope you enjoyed that video and you found it useful. This was going to be a 10-part series, however, I'm going to shorten it to 8 because I have so many ideas that I want to bring to you and I'm feeling quite restricted by having this 10-part series, and I'm sure I can bring you the same value in 8 videos rather than 10, so that's what I'm going to do. Worry not, I'll still be talking about finances, but I'll make short, more digestible videos rather than long series stuff because I think that's a bit more useful. Okay, as always, thank you so much for watching. I really appreciate you, and I'll see you in the next one.